Did you know that there's an indicator that shows you whether we're in a bull or a bear market? Plus, it also shows you some key support and resistance levels. What's up? My name is Caroline and this is Wealth in Progress, where you'll learn how to make passive income with cryptocurrencies. This video is the fourth part of the chart reading course for beginners. In the last 3 lessons, we looked at candlestick chart reading, we looked at support, resistance, and trend lines. Plus, we already looked at 2 key indicators, being the moving averages and the Bollinger Bands. Today, we'll look at 2 more very important indicators, being the RSI and the Ichimoku Cloud. Now, if you want to take your crypto strategy to a whole new level and actually buy when whales are buying, aka at the bottom, then you need to join our free masterclass. This is where you'll learn how to use on-chain metrics that have made Kieran and me over $50,000 in profit. So if you're tired of missing the bottom, then go down in the description, click on the first link and sign up for our free masterclass. You'll then receive a personal invitation for the masterclass very soon. All right, let's dive in. So we'll again look at TradingView. Link as always is in the description below. So right now we're going to start with the RSI, and right now I've only got the RSI displayed here other than the volume. So the RSI is always displayed on the lower part of your chart. So you've got your candlestick chart up there, the volume in the middle, and then down there you've got the RSI. As always, how to find that is going to the indicators and then just type RSI in here. And you see that's this one. So to add that, that's always the same. Just go over to indicators, type in RSI, and then just click on that one. Now there are a lot of different options, but you can basically just choose the first one. So let's look at what the RSI is even standing for. So RSI stands for Relative Strength Index, and according to Investopedia, this is the definition. The Relative Strength Index RSI is a momentum indicator used in technical analysis that measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a stock or other asset. The RSI is displayed as an oscillator, a line graph that moves between 2 extremes and can have a reading from 0 to 100. Traditional interpretation and usage of the RSI are that values of 70 or above indicate that a security, or a cryptocurrency in our case, is becoming overbought or overvalued and may be primed for a trend reversal or correction pullback in price. An RSI reading of 30 or below indicates an oversold or undervalued condition, meaning the opposite, that a price reversal is expected. So let's go back to TradingView. So let's take a look at what we've just learned. So you've got those extremes. So you've got the upper line and the lower line, and you can see the lower line is at 30, the upper is at 70. So this is the range we're looking at, and what we're looking at is when it goes out of each range. So going above the upper range, above 70, that means that it's overbought or overvalued, and that means that generally the price is drawn back to that middle range and that a price reversal is expected. Same as on the other side. So if it goes below that, you expect that the price moves up again, so that it goes back into that range. And you can see that just as an example, the last time it went below 30, so here it went to 20, so that's pretty low. On January 22nd was at when BTC was at 30, about 34,000, 33,000, and then after that it moved up again because the price gets drawn back in the middle here. Now the RSI oscillator in this case is the purple line. Now you can't see that too well, so what you can do is you can change those parameters, or you can change the settings. So if you hover over the RSI over the indicator, you see that setting wheel, so you can just click on that and then you can change everything. So what I'd like is having a bit stronger color. Yeah, let's take this one, and then you can also make it stronger here. So let's take that one, just that we see it a bit better. And then the other line, the yellow line, that's actually just the moving average. So I generally don't use that, but that just comes with that specific indicator. But what you could do is you could also just take that out. So if you untick that box, then it doesn't show up, and I prefer having it this way, so we only have the oscillator. Now, as always, you can't only look at one indicator in terms of your decisions, in terms of trading, swing trading, hodling. So for instance, it's definitely an indicator that once we go above the 70 line, that a price reversal will be coming soon. But if we just take this as an example, July 30th, you see that it went into the overbought range, into the overvalued range. But let's look at what BTC did there. So yes, it went to 42,000, then we had a bit of a pullback, but after that it just went higher, 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 and then the highest point, the all-time high, was only reached in November at around 69,000, 68, something like that. So if you sold there only based on that indicator, that would have led to you losing out on quite a lot of gain. So it's very important to always keep that in mind. You need to look at the combination of all of those indicators and also at support and resistance lines. If you haven't checked out my previous lessons, the links are in the description, so go check those out first, and then you'll understand how this all ties up together. Now, another interesting aspect that the RSI can show you are bullish or bearish divergences. Now, what that means is, as you can see, usually the RSI and price movements are basically synchronized. So you can see here it's going up, the price is going up, and the RSI is going up. Then it's going down, price is going down, and so on and so forth. But what happens is that sometimes the RSI has a different movement than the price movement, and that's when that divergence happens. So let's take a quick look at the definition to see what that means. So a bearish divergence occurs when the RSI creates an overbought reading followed by a lower high that matches corresponding higher highs on the price. Now, in my opinion, this is not only in the overbought or oversold range, but in general, if you see different movements than the price. Let's take a look at the charts so you see what that looks like. So for instance, one very clear divergence was this one. So I'll just draw a line here. So what you can see is we've been in a really crazy high overbought range here. So it went up until 90. That's about the highest it ever gets on January 7th. Or in January 2021. But what you can see here, that has by far not been the all-time high. So that was around 40,000 and it went up to almost 70,000 as the all-time high. But let's look at what happened. Okay, so it decreased, that stays the same, but then it went higher, almost all-time high, a pullback, and then the all-time high was only reached here. But what you can see is what the RSI did is that it actually created lower highs. So what you would theoretically expect is that, okay, the price has been high here, but then it goes even higher, so the RSI should be even higher, right? But technically, it can't really go above 90. I mean, 100 is the max, and I've never seen it go above 90, so that's really the absolute highest. So even if it can't go above that, you would definitely expect it to go to the same range, at least for the all-time high, right? So you would definitely expect it, when it reaches this all-time high, you would definitely expect the RSI to be at that similar range at around 90. But what it did is it decreased, it built lower highs every time. So for every peak, the RSI had actually a lower high. And that's a classic bearish divergence that shows you that a price reversal is imminent, that it is expected that the price will have a pullback because it wants to be pulled back into that range and it can't keep up, the momentum can't keep up with the price movement. But you need to be very careful because you can see already here, you could see that there's a divergence. So theoretically, you could have sold everything here, but then you would have missed out on that top. So you always need to wait for that scenario to play out. But what you could do is you could DCA out. So once you see a divergence like this, you can start selling with every lower high. So if you see that plays out like that, you could sell a bit here, then wait again, see what happens. Oh, another lower high, you could sell a bit more. And that's what will probably get you a better selling price than if you started selling immediately, if you see that divergence, or immediately if you see that it is in the overbought range. Now let's look at a bullish divergence. So I'll draw another line here. Okay, so what do we see here? So on May 19th, the price actually dipped pretty low with the wick, but the body stayed pretty high. So the body was at 36,000, and yet the RSI went very deep into the oversold range. So then the RSI went up again, price went up again, but then the actual all-time low of this cycle was at 29,000 on July 21st. But what you see here, the RSI doesn't dip that low anymore. So again, you would expect to have a dip to at least that same range. So RSI wise, that would be around 22. So you would expect it to go that low, but it didn't do that. It stayed higher. So that's another indicator that a price reversal is probably imminent. Of course, there's no guarantee with those indicators and with those patterns. That's just what is likely to happen, but you've never got a 100% chance. So always keep that in mind. In hindsight, you're always smarter, but just keep that in mind. It's a good indicator, but you've never got a 100% guarantee. Now, the next indicator that can help you determine momentum is the Ichimoku Cloud. And that can actually show you whether we're in a bull market or a bear market, depending on the time frame we're looking at. So let's take a look at the definition. So according to Investopedia, it says, the Ichimoku Cloud is a collection of technical indicators that show support and resistance levels, as well as momentum and trend direction. So you've basically got everything that you need all in one indicator, which is pretty cool. It does this by taking multiple averages and plotting them on a chart. It also uses these figures to compute a cloud that attempts to forecast where the price may find support or resistance in the future. Alright, so we go back to Trading View and then again go to Indicators, and then you can just type in Ichimoku Cloud and add that. Okay, we'll close that window. Now, at first glance, that looks really complicated, but don't worry, we'll go through that step by step. First of all, there's a bit too much going on here and you can't really distinguish what it says or what it displays. So what you need to do first of all is go to the settings and then adapt each parameter. So first of all, you've got two clouds, so you can barely see that, so we definitely need to adapt that, but you've got a red cloud and a green cloud. And these are these two colors, so I would first adapt that, definitely make it more visible. So I would put the opacity somewhere here, 60-70%, something like that. And then let's do the same thing with red. Yep, so that you can clearly see what's going on. Then we've also got three trend lines. So you see that here there are three. So one is green, one is blue, and one is red. And what you can see, you can also see that here. So if you take a close look, it says Ichimoku 9, 26, 52, 26. So it's actually 29, 26, and 52 moving averages that are also in there. So you can see these are these colors. So I would also just at least make them a bit thicker so that you see that's here, so that you see them a bit better. Now, these two leading spans are actually the outsides of the cloud, so these are not super relevant, so you can leave them like that. Now, you don't really need the lagging span, so I would either take that out or at least make it like not very visible. So we're gonna make a thin line with that, so we just see that, but you don't really need that. What you actually need, what our most important parts are the clouds and then the conversion line and the baseline. Now the clouds are actually built and the color is determined by those two lines that are the outer lines. These are the leading spans, and when the leading span A is above the leading span B, then the cloud is green, like here. And if the leading span A is below the leading span B, then it turns red. So let's just make leading span A a bit more visible here, so you can see if it's higher than leading span B, then it's green, and if it's lower than leading span B, then it's red. Now, what that basically means is that as long as the cloud is red, then we're in a bearish movement, in a bearish momentum. So it is expected that the price that we're going sideways or lower and the momentum is bearish, and then once that turns green, the momentum is turning bullish. Now what you can see is that this cloud actually moves in advance of the price. So you can see here that it has just turned green. Now what that means is we're not there yet, but what it means that is that it is expected that we're turning bullish soon. So we've been in a bearish momentum right now, and we're turning bullish in the very near future. If that stays green, that can change very quickly again. So if the leading span A again goes lower than leading span B, then we could soon be in a red cloud scenario again, and that would be bearish again. So you can see here we've had a very short bearish span, and that's most likely because of this scenario. It's always in advance, so you always have to look a couple of days back. So right now you can see that's a couple of days difference. Yeah, so that's about 15 to 20 days difference, and then it turned bullish again because the price was moving up again. So this scenario here made it red, and then it turned bullish again. So it can change pretty quickly. Now, what's another important aspect of this bearish bullish scenario is if the candles are above or below the clouds. So red is generally bearish, but what makes it even more bearish is if the candles are actually trading below the cloud. So you can see that has happened during the past couple of months. It traded below the cloud, and that means that is expected that the price will move lower. On the other side, if the price trades above the cloud and it's green, that means that it's a bearish momentum, and it is expected that the price will move higher. Now, as soon as the price actually moves within the cloud, we're in neutral territory. So that means we're neither bullish nor bearish, and we have to wait and see in which direction it will break out. Now, if you look at this example here, it has been trading in the cloud, but during this period, it has likely turned red here already. Because it's a couple of days in advance, it has likely turned red, and that will give you an indication that we can expect the price to break out of that cloud on the downside. Versus if that stayed green, then you would expect it to break out on the upside. So if you look at the price action of the past couple of days, you can see we've moved in the cloud, so that's neutral territory, not sure what's going to happen. And now we moved out of the cloud again, but it has turned green. So that's a very unsure situation because it could really go both ways, but as long as it stays below the cloud, it's rather bearish. So I would expect for that to either stay a very short green scenario, green cloud, and then turn red again. Or if we see the price moving back into the cloud and it stays green, that's when I would expect that it would move out of the cloud on the upside. But again, that can take a couple of days or even weeks, but it is a good indication of where the trend is likely moving next. Now, while you could make it a lot more complicated, these are the basics for the Ichimoku Cloud. And this will also help you understand our weekly newsletter a lot better that we send out to our newsletter subscribers. If you sign up to the Masterclass, you automatically sign up to that as well. And that gives you a glimpse into our weekly technical analysis and on-chain analysis reports that we share in the Academy. In the Academy, you get much more details and much more on-chain, basically everything you need to know in order to understand where the market is moving next. But having that knowledge combined with all of the other indicators and everything that we've discussed so far will give you a pretty good understanding of general market movements. Now, if you want to add some on-chain metrics to that, to see what whales are doing, to see where the big money is flowing and how they influence the market, then I highly recommend subscribing to our Masterclass, which will be held pretty soon. This will help you get an edge in the market to see future market movements well in advance. Also, don't forget to subscribe to this channel because in the next lesson we'll look at triangles. This is the last lesson of this chart reading for beginners course, and that will give you the final knowledge that you need in order to see all the possible patterns that are likely to occur. Now, of course, there's much more to know about that, and we'll have some more deep dive lessons in the DeFi Academy. But for the basics, this is everything you need to know. The triangles and wedges are a very important part of that. So don't forget to subscribe so you'll be notified when that comes out. If you like this video, hit the like button down below, share with your friends, and be sure to subscribe. Thanks for watching, and I'll see you in the next video. Bye!